Alright guys, so as you can see on the chart in front of you, we actually had a pretty good example of a head and shoulders pattern on the Aussie dollar, and we're going to come back to this trade after the tutorial part of this video and check out some more in-depth analysis on this specific trade. So now let's go ahead and get into exactly what we're looking for when it comes to a head and shoulders pattern. Alright guys, so what we see on the screen here is a standard head and shoulders pattern. It consists of four major parts. We have the left shoulder, the neckline created by these two swing lows, the head, and the right shoulder. The standard head and shoulders pattern is a reversal signal and normally happens after a long period of an uptrend in a market. And these patterns are meant to give us an idea or to give us a hint that the market could be reversing trend. So it's a trend reversal pattern, and it can be used in trend as well, but we'll talk about that a little later in the video. For now, let's just focus on this pattern, guys. If this is something you want to incorporate into your trading, then this pattern that you see on your screen is what you need to train your eye to be able to see. You need to train your reticular activating system to notice this shape that you see on the screen in front of you very quickly and very easily. And just to get a little more in-depth into what we're going to be looking for, guys, I'm actually going to draw out a head and shoulders pattern just to make sure everybody understands what we're looking for. We're looking for this peak, low to a high, and this, as I was talking about earlier, normally follows a pre-existing uptrend. So the market being in an uptrend, and then we look for a retracement, and this is what's going to create our left shoulder. Next up, we need a head. Coming from the beginning points of our neckline, we then get a head. Then a retest of the beginning points of that neckline, followed by our right shoulder, which comes up to retest that left shoulder. And that's exactly what we're looking for when it comes to these patterns, guys. And this type of pattern would be considered the standard head and shoulders pattern. And there's one other type of head and shoulders pattern that we're going to talk about today, and that is the inverse head and shoulders pattern, which is the direct opposite of the regular head and shoulders pattern. So let's briefly go over that pattern. So here we have the inverse head and shoulders pattern, guys, and this is the exact opposite of what we were just talking about. We would need a market that's been in a previous downtrend to find a low, create a high of the neckline here, then create a lower low for the head, then a similar swing high as the previous neckline, then a right shoulder similar to left shoulder and break of that neckline. So this is an example of what we'd be looking for as an inverse head and shoulders pattern, and this is actually what we took advantage of on the Aussie dollar. So now that we know what we're looking for in the market, we can actually start talking about how we can place trades using this pattern. So of course, the very first question we have to ask ourselves is, how can we enter this pattern? And there's actually a few different ways you can do that. And I'm actually going to go ahead and draw out a couple of examples of how we can enter this kind of trade. Alright guys, so a couple of different ways that you can enter the market using this kind of pattern. Of course, you have your standard entry, which is the break of the neckline. So what we'll be doing is drawing a horizontal line there at the neckline and waiting for this market to break past that neckline in order to enter the market. This is the standard way that the head and shoulders pattern can be traded. There's also a couple of other ways. In this case, your entry would be at the close of the breakout candle, which would be right there. Now, another way to do this is to actually enter at the right shoulder. So after we have a left shoulder created, then our head, retracement up to the neckline, back down to our left shoulder. At this point, you could use that left shoulder as structure and enter the market at that level. Now, you can do this either by placing a limit order directly at the left shoulder, which may or may not be beneficial, guys. You will also have to test all of these ways yourself in order to figure out which is best and which fits your trading style best. But another way, and probably a more accurate way to do it, would be wait for the market to get down to that left shoulder and give you some kind of entry reason to go long. Something like a long wick to the bottom would be an example of an entry reason, some kind of hammer candlestick formation at that left shoulder, or any other candlestick formation or entry reason that you could think of. Now, you can also get very creative with this, and you can wait for the market to break that neckline of the head and shoulders pattern and actually do a Fibonacci retracement to that next high. You can pull a Fibonacci retracement from your right shoulder up to your next high and wait for the market to come down to a 382 retracement, or to come back down, retest that neckline, would be another way to enter, or come down and retest any of these Fibonacci retracements. And this is a way you can actually trade a head and shoulders pattern with a limit order, which can be beneficial if you have a full-time job that doesn't allow you to consistently check the charts. So in this case, we would either wait for a pullback into a Fibonacci retracement or a pullback into that neckline for our entry. So there's a few different ways that you could enter the market using this head and shoulders pattern. Now let's talk a little bit about stop and target placement. Before we go to the charts and take a look at some real life examples of these patterns, let's consider that we take our long position out on a close above the neckline. That's what we'll use for now as our entry. So there's a couple of different options on how you can place stops using this pattern. The first option is you can use the shoulders as structure and place your stop loss just below the left and right shoulders, something like this. Now, of course, this does come with its drawbacks, one of which being the market could come down and retest the head of this pattern, retest this swing low here, something like this, and then push up to hit what would have been your targets, and that is unfortunate. But it also comes with its advantages. Doing this will make it easier to hit your first targets if you require a one-to-one risk reward, and will also give you a better risk reward if you use previous structure for a target. And speaking of the disadvantages of putting your stop loss below the shoulders of this pattern, you could also take a stop loss below the head of the pattern. This has its advantages. If the market comes down all the way to test the head of this pattern or the swing low of this move, then you will not be stopped out and this market could push up to hit your potential targets. But also this gives you a less positive risk reward profile and less of a chance of hitting your first targets if you require a one-to-one risk reward. So there's a couple of different ways you can place a stop loss using this pattern and the advantages and disadvantages of those ways. Next up is targets. Now for targets, you could use previous structure. Let's say the market has been in a downtrend and has a previous structure high right in here. We're looking to the left side of my chart, guys, where I'm drawing this green box. So let's say the previous high of this market is here, and that's the previous structure level. Well, that's a place where you could consider taking off the first part of your position or all of your position if you're just a one position trader. Now something you can also use is a Fibonacci extension. You can go from the head up to the neckline and back down to the head, and you can use a 1618 extension for your first targets. And depending on where this breakout takes place, you may not get a one-to-one risk reward there, and you may have to adjust appropriately for that situation. So guys, that's what we're looking for when it comes to a head and shoulders pattern. That's a couple of ways to enter the market, a couple of ways you can decide to place your stop, and a couple of different ways to place targets on this trade. Now let's go down to the charts and take a look at a few real life examples of this pattern, and then we'll discuss a little more about the analysis behind that Aussie dollar trade that you saw at the beginning of the video. Alright guys, so here on the dollar yen, we actually have a really good example of a head and shoulders pattern, and I'll give you guys a second to see if you can spot it. So here we have a market that's coming up in an uptrend, right? We have a swing high, swing low, swing high, swing low, swing high, swing low. And what do you notice about this swing high and low? This is the creation of our left shoulder. Then we have our head, finishing touches on our neckline, our right shoulder, and the breakout, guys. And that's about as good of a head and shoulders pattern as we're going to be able to find. So let's take a look at a few different ways we could have entered this specific pattern. Of course, our standard entry and most popular entry, the break of the neckline, which would have put our entry somewhere down here, looking at the close of that big red candle. Now again, that entry comes with its advantages and disadvantages, which we've already discussed. Entering the market after that breakout may put you a pretty good ways away from your stop loss, which means you have less of a chance of hitting your first targets and a worse risk reward ratio. Now something else you could do, and another way to enter this trade would be to place a sell stop order just below the neckline of this pattern, and that's something we're not really going to discuss in too much detail here. It's a little more advanced than I like going into here on YouTube, but that's just another option. But as for this entry, on the close of that breakout candle, you would have a worse risk reward than as if you were to enter on a retest of this left shoulder. That being the case, you would have an entry much higher, meaning that your stop loss would be much smaller. You'd have a better chance of hitting that one-to-one risk reward and a better risk reward ratio. Now the third way we discussed being able to enter this is a breakout of the neckline and a pullback that comes close to that neckline or touches that neckline, along with incorporating a Fibonacci retracement. In this case, we would be pulling from our right shoulder the swing high of our right shoulder, down to the newly created swing low after the breakout, and we discussed possibly trading off of this 382 retracement or one of the other retracements along with at this neckline. So with that being the case, you could have entered the market at the 382 retracement with a stop loss above your right shoulder. And as you can see, any way you would have entered this, you would have ended up hitting targets on the specific trade. Now that's not always the case, and it's important to know that these patterns do not always work. This is not a 100% winning pattern. I just pointed out a winning trade, but what I'm going to do is actually show you guys a losing head and shoulders pattern, because it's very important to realize that just because you watch this video and you understand how to trade a head and shoulders pattern, that doesn't mean you need to go out in the market with live money and start trading these patterns. I would actually strongly request that you not do that. I'm showing you guys all these different ways to trade head and shoulders patterns so you can go out in the market and back test any of the specific ways to trade this pattern that fits into your trading plan and understand the risk involved before trying to trade it with live money. So let's take a look at a losing head and shoulders pattern, and then we'll talk a little more about the Aussie dollar trade that you saw at the beginning of this video. Alright guys, so on the chart in front of you, there's an example of a losing head and shoulders pattern, and I'm going to go ahead and let you guys see if you can point it out. Now it's just as important to be able to point out a losing head and shoulders pattern as it is to be able to find a winning one. And the reason is because during your back testing process, when you're testing the market for these patterns, you're going to need to actually look for the losers. Your eyes will naturally gravitate towards winning trades. So looking for the losers will be a good plan. Now as you can see, the dollar Swiss here on the 4-hour chart has been in a downtrend. We're pushing down, pushing back up, and then we create our left shoulder right here. The beginning stages of our neckline, the head of the pattern, the rest of the neckline, the right shoulder, and a push up. But if we look left and consider that our targets may have been at previous structure, you can see that this market never did test that previous structure before falling down and hitting what would have been the stop loss on this trade. So there's a good example of a head and shoulders pattern, and a perfect pattern according to the rules of a head and shoulders pattern that ended up being a losing trade. Very important to remember, guys, not every trade is going to win no matter what strategy you're using. So I hope you found these two examples helpful. If you did, go ahead and click that like button for me. I'm going to head over to the trade that we looked at the beginning of this video on the Aussie dollar, and we'll talk through the analysis on that trade. Alright guys, so here we are on that Aussie dollar trade, and what I was looking for out of this trade is for the market to come down, create this head of the pattern, push back up, and test our left shoulder. Once we test that left shoulder here, then I was waiting to see if the market could provide some buying pressure from that left shoulder, and that's when we decided to enter this trade after seeing what we consider buying pressure, and the trade pushed up to hit our first targets quite easily. First targets were at this previous level of resistance right back here. So now that this is the case and we have hit those first targets, I've put a stop loss right above break even, and we're waiting to see if this market can push higher into our next resistance level, which will be in this area here. So that's what we're looking at in the future for this Aussie dollar trade. Let's check out why I considered this a good trading opportunity, guys. If you've watched a few of my videos, you know that I have to have a certain set of conditions met in the market before I trade any type of strategy. And for this trade, I had those conditions met. And in order to show you that, I have to zoom out to a higher time frame. So let's jump back into a 4-hour chart. And here on the 4-hour chart, guys, you can see that we had a level of structure looking left, right where this head and shoulders pattern happened on the hourly time frame. And although on the hourly time frame we were in a downtrend, if I delete some of these lines, it may make it easier to see, guys. Sorry about this. Here on the 4-hour chart, you can see that we've just broken above and closed above our previous resistance. Now since then we've just consolidated, but that gives me an indication that this may be a point where the market wants to head higher. So having those two things as a bias in the market, plus getting this entry reason with the head and shoulders pattern, is why I considered this a good opportunity